Good afternoon and welcome everybody to today's webinar where we're going to talk about how you can create a profitable Forex trading strategy. Now, what you probably have been doing up until now is you've been looking at, different forums and, system providers and things like that, trying to find that perfect Forex trading strategy. And a lot of the times they're going to be missing one or two components that really are required for the longevity in a strategy. And also you've got to take into account that sometimes you're going to find strategies that kind of they don't meet your psychological profile. So what the best thing actually is to do is really go to the drawing board and create something that completely fits in with your schedule, with your approach, with the way that you want to go about trading. And in this webinar right here, I'm going to give you all of that information. Hey Sunil, how are you? Nice to see you again. So let's get going with the webinar. And also, whilst we go through this webinar here, it is interactive. So please make sure if you do have any questions at all, that you feel free to ask the questions and everything. And I don't necessarily know the answers to everything, but if I do, I'll give you the answer. And if I don't, I will find a way of getting you that answer. All right. Hey, Bob, hopefully you are well as well. Okay, so for those of you that don't know us, who are we and how can we help? So my brother and I have been trading the currency markets and the financial markets since 2005. In that time, we established and ran an investment fund. We've done that since 2008, and we've taught tens of thousands of traders globally how to trade the markets. And we've been resident educators here on FX Street for probably about 10 years now. And we're regularly featured in the financial media. And probably most importantly, we've developed the ACT framework and the TCM Market Edge, which is basically an approach for trading the markets and a software package that helps traders like yourselves make consistent profits trading these markets. Okay. And we've been trading coaches for over a decade. And the reason that part is important is that lots of times you can get traders that are very good at, trading and making money from the markets, but they aren't able to articulate what it is that makes them successful. And also, importantly, is that they don't really understand some of the hurdles that the average retail trader would face. Someone like yourselves who are sat here watching this that don't have the benefit of, a mentor or something like that, or somebody to sort of sit next to them and trade with them, you face some pretty unique issues. And, if somebody that's been trading well and professionally for a long time, they wouldn't really have knowledge of that or wouldn't be aware of that. Whereas because we teach people to trade all of the time, we are acutely aware of some of the issues that you face, and everything that we build in terms of our systems, our frameworks, our ways of creating strategies always has that in mind, that it needs to be easy to follow, it needs to be process driven, and it needs to be something that the retail trader, and I say retail trader, home trader, is able to use to make money from the comfort of their very own home. So today, you are going to learn to create a profitable Forex trading strategy from scratch. But first of all, please make sure that you get rid of all of your distractions. All right. So if you've got anything going on in the background there, if you've got emails opened up and anything like that, then please close that all up for the moment. It's not going to be a long time. These webinars are only sort of 30 to 40 minutes long. So, just give me the next 30 minutes of your time. I promise you will not regret it. So this webinar is for people. Why is my keyboard not working properly here? I guess we'll just have to be using the mouse because the keyboard is refusing to play ball. So this webinar is for people that are brand new to trading or experienced and are basically looking for an effective strategy for making money from the Forex market. So I'm going to teach you how you can create that strategy, but whilst I'm teaching you it, I'm going to give you some components that I like to incorporate into my strategies that really help me. So you get the best of both worlds here. Now, it's also for you if you understand that there isn't a single system out there that will give you a 100% strike rate. All right, you have to be comfortable taking losses. Steve says there is no sound. There is sound. I don't know if somebody can type into the chat box. Maybe Adinda, you could type into the chat box so that Steve knows that there is sound and maybe he should log on again. Okay, so if you understand that you're going to take losses. And trading is absolutely about, being able to take losses. And then obviously once you've had your losing streaks and things like that, the wins will then come as well. But it's not something where you're going to get a 100% strike rate. You're not going to be right on every single trade. It's impossible to do that. All right. And those of you that are looking for that, unfortunately, you're not going to find that anywhere. It's not just that I can't deliver that to you. It's anybody. No one can deliver something that's 100%, right, without taking excessive risks, as in like ridiculously large stops, which, you don't take a loss until you wipe out your entire account. That sort of approach right there. And obviously you have to be willing to follow a strict set of rules and not interfere with something that's really proven to work. So once you've developed your strategy, you have to have the ability to follow your strategy, not to interfere with it when you're in the market because you feel like something is going to go a different way. All right. Now, this is not for you if you're looking for a get-rich-quick scheme, okay? Or if you intend on funding your trading account with money that you cannot afford to lose. Money carries a very, very high level of risk. If you do this incorrectly, you can lose everything that's in your trading account, all right? And in certain circumstances, you can actually put in more, you can lose more than your initial investment. So that's something that you really have to worry about. So if you're trading, if you're somebody that's looking at this as being sort of like the way for you to get out of financial difficulty, this, by all means, learn the art of trading, but don't put your mortgage money into your account, because when you're trading with scared money, you will end up losing it. It's almost a mathematical certainty, all right? And obviously, as I just said, if you're looking for that trading strategy with no downside risk, then, this isn't for you. So there are various components that go into making a profitable trading strategy. And in this webinar right here, we're going to talk about what those components are. But if we break it down, there are 4 primary components. First, we need to determine the direction that we want to trade in. Once we've determined the direction, we then need to identify areas of interest. Now, trades work out much better if you understand exactly where you're trading. So that is, if you're taking a bounce from support, for example, okay, then you want to take the trade when the market gets to or around that support level. If you are taking a trade in the middle of a trend, that's fine, as long as you aren't taking a trade into a support or a resistance level. Then you need to be able to define your entry. And then finally, you need a way of managing your risk. Does everybody understand that? So let's first talk about establishing a directional bias. Now, establishing a directional bias is something that every trader should do before they even consider taking a trade. But few actually take the time to do this properly, all right? The reality is that if you do this correctly, everything that comes after it is infinitely easier. You wipe out a good portion of your losses if you can develop a directional bias effectively. Because then you're not taking trades against the trend. You're not trying to swim upstream. Now, there are various different ways that you can determine your directional bias. You can use fundamental analysis. Okay, and that's basically trying to front run the central bank, something that we do. You can use technical analysis, which is something that I'm going to focus on in this webinar here, because I think it's easier for a new trader to understand and get on board with. And you can use sentiment analysis, which is, how are the markets feeling right now? How's the tensions going on with Russia and the Ukraine at the moment? How is that going to affect the markets? That's a little bit more difficult to understand, but it's very powerful when you do understand it. All right. But the key is obviously to have an process that is repeatable. Now, once we've developed our directional bias, the next thing that we have to do is we need to identify an area of interest. We need to know, as I just said, where are we taking our trades from? Retail traders take entries from anywhere on the charts. They're only focused on the technical trigger, and they have absolutely no regard for where this trigger actually presents itself. Professional traders, what we do is we always look for context. We try to find trade opportunities and trade entries that offer the best risk to reward ratios. I don't want to buy into a trend if it means that the trend is already quite extended and I have to put my stop so far away that it's unrealistic for me to be able to have a profit target that makes sense. So I have to always weigh up the reward to risk. Now, most of the time, the best entries are found at levels that markets have already identified. So you're looking at support and resistance levels and things like that, or prior to it. So once you've developed your directional bias, you have your area of interest, then we need to determine our entry. We can't leave our trade entries, all right, up to how we feel, as typically we're going to make the wrong decisions. Retail traders suffer hugely from confirmation bias. How many of you have experienced that before? Where you see a trade, you want to be in that trade, so you then go away and you collect and you gather all of the evidence, all of the analysis that supports the idea that you want to trade, rather than doing it the other way around, looking at all of the evidence, okay, doing your analysis and then deciding dependent on the analysis, should you be in a trade or not? Should you take the trade or not? But retail traders don't do that. They decide and then they find the information that supports that. Our entry rule should be as objective as possible, okay? Because what this does is it allows us to make the same decision again and again and again, even at a heightened emotional state. And then finally, we need to have a way of managing our trade. Few traders actually pay attention to once they're in the trade. Similar to entries, many traders believe that they can determine how to manage their trades based on their experience and their general feel for the markets. That's what retail traders do. But the truth is that actually there isn't a more dangerous time to make a trading decision than once you have entered the market, once you have money on the line. We have to put rules in place so that once we get to the point where we need to decide, do we take profits, do we take a loss, that actually we're just following a decision tree so that we know that if this happens, then we do that. And what that also allows us to do is it allows us to then later on go back and review our trades and say, that trade cost me money. My rules for getting out of the trade was this, but actually I did this. And then over a long enough period of time, once you get to see that, I'm costing myself money. Every time I do this, it costs money. And you don't just do it from sort of like an abstract perspective, but you actually have the data there to prove it. So you can quantify how much your mistakes are actually costing you and your trading account. It's really, really important that you do this. It's not good enough just to say this costs money or this makes money. We have to quantify everything so that we understand exactly what that means to us. And if we change that or we do more of it, what does that mean to our edge and to our trading account over time? Is everybody on board so far? Are there any questions? So once you have your trading strategy, and these are the components, we're going to jump over to the charts in just a minute. We're really going to look at these components and see how you can sort of add them into your trading. But once you have all of this, you still need to understand how to trade your system. You have to understand that your edge needs time to play out. Has anybody ever been through an exercise of flipping a coin, heads, tails, heads, tails? Have you noticed how sometimes, if you've done that, you can get like 5, 6, 7, 8, 9, 10 heads in a row? Even though the coin itself has only two sides. So realistically, you've always got a 50-50% chance of it being heads or tails. So one would assume that if you flip the coin 4 times, you get 2 heads and 2 tails. But actually what happens is that you could flip it 10 times and get 10 heads, or 8 heads and 2 tails. Has anybody seen this before? Has anybody observed that when they flipped a coin? Was no one on this webinar here ever flipped a coin before in their life? But it does happen, believe me. So the answer is, or what do we have to do about this? We need to understand that our edge needs time to play out. So you can have the best strategy in the world, but you cannot measure the success of that strategy based on 1, 2, 3, 4, 5 trades. You have to give it 10 trades, 20 trades, 50, 100 trades before you start to pass judgment. And some of you will say, well, how can I do that? How can I take 50 trades in a row to decide how a system works, or whether a system works or not? Well, the answer is you don't have to. You can actually backtest. So when you're trading technically, this is one of the benefits of trading technically and having defined rules, is that you can go back on your chart. Yes, you can get testing software, but without the testing software, you can go back on your charts and you can go bar by bar, and you can test your strategy. You can build up the statistics on your strategy without having to put the money into the markets, and you can accelerate it. So whereas if you were live trading and you were live trading the daily charts, it might take you 1, 2, 3 years to build up 200 to 300 trades. It could do. But you don't want to wait 3 years, right? So what you do instead is you backtest your results. You backtest your results, and within the course of a day or two of solid backtesting, you can have years of data across many different currency pairs that can tell you how effective your strategy is. Okay? So to recap on the components of a strategy, we have to have a way to determine the direction. We then need to have a way of identifying an area of interest. We then need to have entry rules and trade management rules. And if you have all of that in place, then you should put yourself in a position, excuse me, where you can have an equity curve like this. You see that everything doesn't, and this is one of our strategies, okay? It doesn't go up in a straight line. There are losses. There are times when the market moves sideways. But over time, given enough time, it does make money. But during these periods where, you're not making money. So let's say, for example, you were trading this strategy. Let me give you a prime example of what retail traders do. So first of all, looking at this equity curve right here, would you all agree that this is a pretty decent equity curve? Would you be happy with this equity curve? You would, right? But what if I told you that between the 1st of January 2019 all the way through to the 1st of May 2019, this particular strategy hovered around break even? How many of you would still trade this strategy? So you traded it for 4 months and it hadn't made any money. It was just kind of up a bit, down a bit, up a bit, down a bit. Be honest, how many of you? 4 to 5 months. Break even's good, but obviously we want to make money, right? But what most traders do is that they say, oh, this isn't making money. Patience indeed is a virtue. But most people, 3 months into this, 2 months into this, would look at this and say, you know what, it's not for me anymore. I'm going to go and find something else. And then what happens? So from May through to August, you get a nice climb in your equity. You get a 30% return. No, nothing changes. This is the point, David. Nothing changes. It's just that the condition of the market isn't always going to be right for your trading. But you have to trade through it. You have to persist. Because what happens trading, like the real trading, okay, not the stuff, not the crap that you're going to find people on Instagram trying to tell you about trading. Real trading, you make your money on a handful of days or weeks in a year. You spend the rest of the time making sure you don't lose the money that you've accumulated. What most retail traders do is that they make money, then they lose a lot. Then they make a little, then they lose a lot. They don't protect their capital. So if we look at this equity curve here, from May through to August, it climbs up, 30% return roughly there. Then from August through to November, you're pretty much in the same spot. So what is that, 3-4 months? And then from November up to get a pretty steady equity curve from November through to June of the following year. You get a massive appreciation, almost double your money, almost 100% return. From June through to September, nothing happens. September through to October, you get a nice appreciation. And then from October through to the 1st of January, you actually take on a few losses and it drops a little bit. And again, retail traders at this moment in time, they throw the strategy in the bin. They look for something else. But just as they throw it in the bin, what happens? The market appreciates. Okay? Now, just because this equity curve is at a high here, it doesn't mean that it's not going to go through a difficult patch where it moves sideways. But that's trading. That's what trading is all about. Are you all okay with this? You all on board? Yeah, I believe this is being recorded, but not by myself, by FX Street Buff. Okay, so let's go into creating a strategy. So we need what? Direction, an area of interest, an entry, and risk management. Let's jump over to some charts and see what we can do. So let's imagine, okay, the first thing we need to do is we need to find a way of determining the direction of a trade that we want to take. Something that I find really, really helps with this is combining moving averages. Now I'm going to pick some arbitrary ones. So what we're going to do is we're going to have, let's throw 100 moving average on there, because it's quite a long moving average that people accept that if price is below it, it's going to go short. If it's above it, it's going to go long, right? And let's come out from a week. Let's go down to a daily chart. Now, this is enough on its own to help us determine which direction is the market going. But we could add a short-term moving average. So something that people do is they have a short moving average and a long-term moving average. And what they say is when the short moving average is below the long moving average, then the market is short and you want to be selling. When it's above, then you want to be buying. Now, don't get me wrong. You're not getting into this trade just because you get a crossover of the moving averages. That's ridiculous. Moving averages are extremely lagging indicators. So you can't take a trade just based on a moving average crossover. You will lose money. These two MAs, that's just a 25 and a 100, David, but you can put any ones you want. This is something you'll test to see what works for you. So we say that that's going to give us the direction. If the slow moving average is below the fast moving average, or the fast one's below the slow one, sorry, then the market is short. If the fast is above the slow, then you want to be long. So in this period here, The orange is a 25, that's above the 100. So we're going to say, okay, we want to be long. Now, what we need to do is we need some entry rules. So one of my entry rules can be, I'm going to take a break of a high or a low as long as price is above the faster moving average. So what constitutes a high or a low? So for example, this here. Oops. Right? You could get involved when the market breaks this level here. Or again, when the market breaks there. And then a little bit further up over here. Now, if you traded on a one-to-one basis, this would have made you money. So this entry here, you would have been in on this candle around there. Your stop would go below the lows here, and a rough one-to-one would be somewhere up there. If you didn't get involved in that trade, you could have got involved when the market broke through this level here. You'd be in at that area there. You place your stop. So the next part is risk management, right? How do we control our risk? So I like to put my stop behind the most recent support or resistance level. So if the market's going up, then I want to put it behind the most recent support. So support is here. I'll put my stop in there. I would go for a one-to-one reward to risk ratio. So if I'm in at 9182 and my stop is somewhere around 9053, that's about 130 pips. So that means that I want to take profit somewhere around 9310. So when the market gets up here. One-to-one reward to risk. Now what you do in that situation, if you've got a reward to risk ratio, okay, of 1-to-1, as in if you risk 100, you make 100, then all you have to focus on is being better, is being right 51% of the time. And you'll break even, make a little bit of money. If you can find where you go wrong and learn to identify your entries a little bit better, then you can push that up to 55%, and then maybe 60% at a one-to-one reward to risk, and 65 and 70%. And then you're making real money. You see what I mean? For a very, very simple system. So we define our direction. We define areas of interest. Okay? Where do we want to trade? What do we want to pay attention to? So our directions are moving average. Our areas of interest are our support and resistance levels. Oh, do we have any big levels that we're trading into here that we need to pay attention to? Maybe this area here, because this is a previous level of support becomes resistance. Maybe this down here when the market breaks through it. Okay. My risk per trade is what you define it as, Jeff. You know, 1% of your account. Risk is quite a personal thing, to be honest with you. So we have our areas of interest, right? Where we want to take our trades, what we want to look out for. We're in this trade here, and we have our stop below there, and our profit target somewhere around here for a one-to-one reward to risk. We know that we're trading into this resistance level. So when the market gets here, I can pay attention to see what happens. And then you can just do this again and again and again, all over the charts. So here, the moving averages are above, prices above the faster moving average. You want to take a break of a high. The market breaks through the high here. You have your stop below the low there somewhere, and you go for a one-to-one reward to risk ratio, which gets you out somewhere around there. It's as easy as that. Or it's as simple as that, rather. I won't say it's easy because trading can be difficult. You've got all of those psychological hurdles that you've got to overcome. You've got to get over. But the process is simple. Who would agree that a strategy as simple as that, as 2 moving averages and a little bit of price action, actually looks quite effective? Any questions? Obviously, you can come back and you can watch this again at your leisure. But if you have any questions now, volume, you don't really have the notion of volume in the Forex market. It's an OTC market. There's no centralized exchange. So that you can't really use volume, Charles. Anybody that tells you that they use volume in the spot FX markets are lying, essentially. Or actually, lying is not quite the same thing. They're not giving you the right view. A broker can show you volume, but they can only really show you volume of their own customers. What you can look at is that you can look at things like the COT report and the open interest. So the COT report will give you a view on where the big money is in the markets, but that comes out weekly. The 2 moving averages, the 25 and the 100 moving average, but you can use, you're going to test, Raymond, with other moving averages to see what makes most sense to you. I have different strategies, George, for different situations. So if the market is trading with momentum, then I'm going to be using continuation-based strategies. If it's in the midst of a big pullback, so something like this over here, then I will have a different way of getting involved in the market. If I'm trading a little bit shorter term, there are certain setups that I won't entertain that I would when I'm trading longer term. So, any other questions? Thank you. I mean, David, I certainly would trade off the daily chart. There was a study done probably about going on 10 years now by a Forex broker. And what they found was that the longer term traders, okay, so the people that were trading and taking positions over, let's say, days or weeks, versus those that were taking it across minutes or hours, the longer term traders were more profitable. They had a higher return and they had a higher win rate. Because remember, with the Forex markets, the longer term direction is relatively easy to pick out. The shorter term direction is quite difficult because you've got a bunch of participants in the FX markets that don't have a profit motive. They just need to repatriate funds or hedge out their risk in a particular region of the world. And that can affect your trades. Startup capital, Charles, you can start with as little as $100. It's all relative. So $100 might be a lot to some people, might not be a lot to others. But you want to start up with an amount that's enough to make you think about the trades that you're taking, but not so much that it scares you away from actually taking those trades. Now, if anybody is interested in learning our strategies and using the software and things and our indicators that we use, then you can get in touch with us, make an application to work with us by going to www.tcmarkets.co.uk/application. All right. You'll fill out some details about yourself, about your trading, what you're looking to achieve, and then you'll be taken to a calendar page where you'll be able to book a call with us to talk about joining one of our programs, one of our paid programs. Okay. So I need to be upfront. It isn't free. But if you are interested in investing in your education and you feel like working with myself and Nikki would be something that would help you go on to the next level, learning our strategies, then please go ahead and take down that URL, fill out, complete an application, book a call. We're booking calls for the moment for the next 4 days. And then we'll see if we can work together, see if it makes sense. Okay? I'm a fresher who wants to the Forex. You need to, yeah, well, not many things, Harsh. You're still able to make money by trading sort of just the basics. So Jeff, my maximum open trades, for example, at the moment I have, hold on, let's go to my brokerage. Let me give you the exact number currently. 1, 2, 3, 4. I have 5 trades open at the moment. Yesterday, that was 9. But I don't trade at 1% risk. I'm a little bit more conservative than that. So I'll trade it like a quarter or 0.5% risk. But the ones I closed yesterday were in profits. The ones today, there are 3 that are in profit. No, there are now 2 that were in profit. There were 3 before I started this, but the euro pound has just gone in the opposite direction. So there are 2 in profit, 3 out of the money. Stephen, in terms of the recording link, that's something that I can't provide to you. So FX Street will need to provide that to you. I don't know if it will be sent to your email. I'm Alex, David. The guy on the left here. Okay. So if there are no other questions, what we will do is we'll wrap it up here. I'll thank FX Street for putting on these webinars. Very, very helpful to you guys, as always. As I said, if you want to, can you invest in our fund, Jeff? We can't actually advertise to the general public like this. If we meet in a cafe somewhere one day, you know, and meet as friends, then perhaps we can have that conversation. But we're only open to, you know, friends and family and experienced investors. So, but in any case, if you're interested in working with us, we can teach you our strategy. So fill out an application. We'll jump on the line and we'll see what we can do. Okay. So thanks so much, everybody, for joining us. And if I haven't missed, I don't think I've missed any questions. If I have, then I'm an idiot. I apologize, but please feel free to drop me an email. Otherwise, I'll speak to you all soon. And I wish you a fantastic day and a great weekend. Take care, everybody.